and welcome back to day 3 and the concluding day for this year's Responsible Business USA 2020 event. For those that managed to join us over the past couple of days, I hope you've enjoyed the discussions and found them of value. If you missed any of the sessions, then do check out our on-demand hub where a number of the recordings already uploaded, but don't do that just yet because we've got a great day of discussions and sessions in store for you. This number of the sessions lined up later today include putting the value on the S in ESG, finance and net zero keynote, moving capital markets behind a clean recovery, the digital transformation of ESG in a post-COVID world, plus a closing discussion on advancing equity and inclusion through ESG investing. But first up, you can see the opening keynote is ready and raring to go. It's my pleasure to introduce the discussion. We have Michael Kashani, the Global Head of ESG Portfolio Management at Goldman Sachs, Catherine Banat, the Managing Director of Responsible Investing at RBC Global Asset Management, Ray Cameron, the Managing Director, Head of Investment Stewardship at the Americas at BlackRock, and Lewis Coppola, the Co-Founder and Executive Vice President, of GNA Institute. It's a live discussion. It's 60 minutes long. So if you haven't joined us for the past 2 days, they're here to answer your questions. So do use the Q&A box at the side of the stream and then try and get through them as the discussion unfolds. But now it's my pleasure to Lewis. The virtual stage is yours.
Thank you so much. So welcome everybody, as Liam said, to the third day of the Reuters Responsible Business Summit USA. 2020, right? What a year this has been. I'm probably not the first to say that. The year of social distancing, social crisis, and I think social exhaustion for many of us. So it feels like it's been forever since we've had a chance to all get together and talk about ESG and sustainability the way that we used to pre-2020. So personally, I've really enjoyed engaging and seeing familiar faces, during this conference this year more than ever. Because it's just been such isolation. In other news, ESG has become mainstream in 2020, so there's that. Every other year, the U.S. Social Investment Forum, right, the trade group for sustainable and responsible investors, conducts a survey which asks institutional investors about their ESG practices. And the 2020 numbers are going to be updated and released next month, which I think is exciting. For me, at least as a geek in this area. But at the start of 2018, the last year that we have data from USSIF, there were $46 trillion in professionally managed AUM in the US. And 1 out of every 4 of those dollars, or 12 trillion, that's 12 trillion with a T, were incorporating aspects of ESG into their investment strategies. And that was at the start of 2018. And so, as we all know, a lot has changed since 2018. It feels like it's maybe the prehistoric times in many ways. So fast forward to 2020, and we're seeing study after study showing outperformance of ESG approaches during the COVID market collapse. We're seeing merger after merger, acquisition after acquisition of pioneering ESG players by the major data ranking index and even credit rating agencies on the street. And in 2020, ESG was already becoming mainstream, but this year we have at least a triple crisis, probably more. But we have a pandemic, we have a social injustice crisis, we have a climate change crisis, and all of these are interconnected in many different ways. 2020 has brought many important social issues to the forefront of ESG this year. It's really put the focus on the S in ESG. And as the title of and the participants on this panel and the others throughout the days of this conference suggests, 2020 is truly the year that ESG has made it to the mainstream and kind of gained critical mass and momentum that we see. Not slowed down by these crises, not disrupted, but maybe in some ways accelerated. And I'm happy to be here today with our esteemed panelists to dive a little bit more into this, to demystify mainstream ESG and what companies out there should be expecting, going into 2021. So before we dive in, can each of you on the panel, tell us a little bit about yourself and your role at your respective organizations? And maybe we'll start with Michael, Ray, Catherine, I guess, just by the order of faces here.
Thanks, Louis, and hello to everyone. Thanks for Reuters Events for having us. Michael Kashani, I am the global head of ESG portfolio management within our fixed income business at Goldman Sachs Asset Management. That covers about 1.2 trillion in AUM and spans all types of investments, whether that's short-term, long-term fixed income, and all types of asset classes. So I know corporates, we have many corporates here today. That seems to be a focus on ESG, but for us, that includes sovereign debt, Supras, securitized like MBS, as well as local munis. So really covering the spectrum of what ESG could mean in different asset classes. And that comes from the bottom up, how we integrate ESG fundamentally, as well as when a client or we have a strategy that is dedicated to an ESG theme or objective, it's working with our fundamental portfolio managers on those prescriptive ESG investments.
Hi everyone. Again, I'll echo what Michael said. Thank you all for giving me the opportunity to represent BlackRock today. I am Ray Cameron, and I run the investment stewardship practice for the Americas. And just to level set a little bit, and that is I'm here representing the index side of the organization. BlackRock has slightly north of 7 trillion under management. Half of that is in equities, and of the equity portion, 90% of that is in index strategies. And so I'm here representing the voice of the index side of the organization. We are viewed as an investment function within BlackRock. We act as a bridge to the portfolio managers across the organization. About 3 years ago, the firm adopted a position that all strategies, all investment strategies would have at least an ESG lens in terms of those investment considerations. So part of the work that we do is incorporated into the other parts of the organization as well. We are viewed as an independent function. We vote independently. There's no BlackRock Inc. vote in terms of the active portfolio managers having to line up with how we vote. The interesting thing is that we tend to end up at the same place. So our votes tend to be closely correlated, but they're not required to be. The other thing I'd say is that, in terms of our principal responsibilities is obviously voting, doing proxy season, and also engaging with companies. Over the past year, we had over 3,000 engagements, which was a record number. And though that number may not seem like a huge number in the total, it does represent over 60% of the global assets under management. So again, I represent the Americas, and we are organized about along the lines of a third in terms of having close to 50 people who are dedicated to this function. That's just on the investment stewardship team. We also have a sustainability research side of the organization as well that we collaborate with and work very closely with. We also do work closely with the active side of the organization also. On the index side, as many of you know, we don't have the option of voting with our feet. If a company is included in an index that is not run by BlackRock, but one that we are replicating the performance of, then we have an obligation to have exposure to that company. And so we use our voice to advocate for sound business and governance practices that lead to long-term sustainability. It's been a focus of ours for a while. I'm very happy to share some of our thoughts and perspectives as we go throughout the day. Just to give you a sense of some of the numbers, and again, in terms of level setting, we did have over 3,000 engagements over the last year, representing over 1,700 public companies in 44 markets. We voted on over 16,000 meetings and over 150,000 proposals. And in the US, the business is organized along the lines of sector specialists. So the analysts on my team have sector responsibility, and they are responsible not only for engaging with the companies, but also voting as well. So I think I'll leave my comments there and look forward to the discussion today. Oh, actually, I didn't say anything about me. Sorry. I'm Ray Cameron. I run the practice for the Americas. Originally from Texas, I have a long career in investment banking. I originated the corporate access practice in the investment banking landscape, and I've been with BlackRock for coming up to 3 years.
Right.
Hello, everybody. I'm going to say good morning, but I'm not sure it's morning everywhere for all of the attendees. I really think we all want to thank you for being here today because I don't know about you, but I'm webbed out. And we actually had a course at RBC about resilience, which says we all need a little bit of recovery time. And it seems to be 5 minutes between calls is really valuable, just as a social hint. I am so honored to be on the stage with Ray and Michael and these two incredible firms, and to be led by Louis, who's just been great in the questions he's prepared us for and the nature of the dialogue. And I think we're going to have a very rich conversation. Ray pointed out they can't vote with their feet or they can't act with their feet. We are an active manager at RBC, and I believe we, as well as Michael, are more active in what we do and how we do it in terms of all of the things we're going to talk about. My role at RBC as Managing Director of Responsible Investing, focused on the US, is to be the ambassador for responsible investing, which primarily for us means ESG and impact investing. There's lots of press coverage. I don't think a day goes by where we can't read 17 articles about ESG from all of the publications that come into our email, all of the publications that we read separately because they're relevant. And I think at the same time, there's a lot of misunderstanding. And my job is really to help parse that for investors, to engage with them, to clarify, and to put all of that information into a context for the individual organization where we can find the intersection of what it is and what they need. And so that I call myself a translator and a translating investor. So that's me.
Thank you so much. I'm also honored to be on this, leading the discussion here, and thank everybody for taking the time, to join. Can now that ESG has reached the mainstream, as we say, can you tell me what is the, this is open for anybody, what is the approach that's gaining sort of the most traction in the mainstream in ESG? You know, there's several different approaches that organizations have taken in the last few years. Some have sort of come into focus more than others or grown more than others. And so what kind of approaches are you seeing gaining that? And just, you know, for the people in the room, what's coming down the pike, right, for the corporates in the room?
So if I could kick that off, I believe that, you know, there's a value proposition to sustainability and ESG, and there is a values orientation. Mm-hmm. And the space has gotten a little confused because people think, oh, I've got to align my values to do this. But I do think that, well, that continues to be important. And we've seen a lot of flows into ESG and impact investing. And our hypothesis is that because people want to act with more, and more can translate into act with their dollars. But at the core, there is a value proposition in sustainability. And, you know, some of the examples are increased sales for products that are marketed as sustainable. The NYU Stern of Sustainability has found that from 2013 to 2018, and I suspect it's accelerated, sustainable products, just labeled sustainable products, grew almost 5 times the rate of products that didn't. So there's a real economic top line revenue driver. But from the S, certainly with COVID, we've highlighted that the social is important. Employees that can pivot, work from home in 24 hours, set themselves up, function that way. And then safety concerns. A lot of investors have shared with us that they want to make sure that the companies are prioritizing safety for their workers, from essential workers all the way up through senior management. There's also a reduced risk component. So by looking at climate risk, companies integrating that into their contingency planning are important. My favorite example is not a corporate example, it's a military example. The military is looking at where they're in flood zones and what they do about the fact that you can't take, a plane cannot take off on a flooded runway. Well, your servers have to be protected from climate risk. Your factories maybe should move out of flood zones. And there is a a growing understanding that there is a direct cost factor. If you look at fuel costs or material waste and you incorporate that into your process more consciously, that goes to the bottom line, as does, and it does seem to have a flow through into the financing cost. So treasurers are increasingly interested in the value proposition behind sustainability. Other thoughts? You can disagree.
I would say, I'm going to say something that's probably get me in trouble in a sustainability conference, in that I don't think we've reached the mainstream. I think we're still bucketing ESG, and what that means is we're still thinking about it separately. We're not thinking about ESG as a fundamental factor in assessing organizations. You have your ESG deck or your ESG dialogue, and then you have your main dialogue. It's, you know, we talk about integration, whether that's in an investment process or an organization. It means the CFO has to be able to talk about ESG. It means the CEO has to be able to talk about ESG and how it's relevant for them. And so what I'd say, what has been accelerating is the conversation, which is unbelievable. I'd commend probably many of the people who are in this virtual room. We've had more discussions with clients on ESG during this pandemic than before. So at a time when many probably expected investors to hunker down, not look at periphery issues, we've actually seen, especially companies, make broader and more specific commitments on ESG. Well, whether that's relative to, you're my asset manager, I want to make sure you're considering ESG risks and opportunities, not because I have a special mandate, but because I expect you to do that as a prudent fixed income risk manager. And then the second, where can I tilt into ESG in a way that's appropriate for me? And I'd say this last part, how can I challenge myself? So what we've seen is institutional investors challenge themselves on, well, this is what I've always invested in, and this is what I'm comfortable with. And so it's part of that dialogue of, how can we show you different strategies that look and feel similarly, but allow you to achieve some of those objectives as an organization that you're speaking to on your calls, on your investor calls, with your portfolio?
I'm going to take a little bit of a different approach, or a different lens. I'm going to approach it from the angle that if you really strip away what ESG is, and we would kind of reorder it and call it GES because the governance piece is so important. If you really strip away what it is, you know, these are things that companies and boards have been grappling with for years. They may not call it ESG, but if you look at the risk factors in terms of managing your employees, managing your supply chain, our view is that companies have actually been talking about these things in the boardroom. They may not have called it ESG, but these are in fact very core issues to their business. And I think it's a matter of how they are talking about it more publicly. And so we pull up these, you know, into these categories of ESG. I've been on panels, you know, where a director has said, well, it just seems like it's the flavor of the day. And I've said to them, well, do you think that how you manage the employees at your organization, is that a risk to your organization? Yes. Well, how do you talk about that? Have you been talking about that in the boardroom, attracting the best talent, et cetera, et cetera? And so I think that it can be a little bit misleading just in terms of the labeling, but if you look at the core issues that we're talking about, this is really good business practices in terms of identifying these risks and having mitigants in place. So first I'd say that. The second thing I would say is that there absolutely is, you know, a keener focus on values investments. And we're seeing that not only from this next generation of investors that I'm sure most people on this call have seen surveys that relate to that, but it's not just that next generation of investors, but it's also the next generation of employees. They want to work in environments where diversity is on display. They want to buy from companies where diversity is on display. They want to work for companies and they want to invest them as well. So we're seeing all of those trends kind of come together, and it does suggest to us in a very meaningful way that there is a slightly different altering of the investment universe. And so as you know, the investor landscape starts to think about that, there is a repricing and there's a reordering, if you will, of allocation, of capital allocation, and we're starting to see that. We certainly think that the pandemic has certainly put a spotlight on some of these issues that may have been considered softer. But the way that we think about engagement priorities, and they can pull up into broad categories of GES, that these are things that are very core to companies, and the markets are really starting to price them in. I would say that in terms of conversations, if you think about conference calls, the quarterly conference calls, it is starting to filter in very slightly. But we're also finding that in terms of our conversations with CEOs and executives and boards in particular, they're increasingly wanting to talk about these issues, and our active portfolio managers are increasingly participating in those meetings as well. So we operate from a very simple definition of sustainable investing here. It is that it combines the best of traditional investing approaches with insights about society, traditionally considered non-financial insights, to generate better long-term outcomes for our clients.
Just briefly, Louis, I know we have a lot. I just want to underscore something Ray said, and that is that it has to be at the board level, and that requires, in many ways, changing the board and having people with this expertise on the board who can drive the conversation around it. We've talked a lot about diversity on boards, and that is very important. But that part of that analysis should be to rethink the criteria. The EU is starting to look at adding ESG expertise and risk managers to every board and demanding that. I don't know in the midst of things exactly where that is in the process, but that is valuable across companies. So I want to highlight and underscore what Ray said about governance and boards. And then I want to ask Michael a very quick question without derailing our timetable here. Are you seeing an acceleration since COVID? Because we are, and I just want to know if you're having that same experience, or if it's not higher on people's agenda than it was a year ago.
I had a naysayer who's no longer with our firm. When I moved from being a fundamental restructuring analyst, I'm a recovering research analyst who used to work on bankruptcies and restructuring. So always have that research hat on. And he asked, what are you doing? As soon as the market has any type of upheaval, people are going to forget about ESG. The exact opposite happened. We had more conversations on ESG than ever. Even in the point where there was the largest market turmoil, we would obviously get on calls with clients, give them our views on the market turmoil. They wanted to spend half of that call on ESG. So I do think that corporates have understood what the challenge is in front of them. And the challenge in front of them is to understand what ESG means. First and foremost, I think education is a big part of our conversations.
Right.
How it's relevant for them, right? It could be relevant for them in different ways depending on what sector, who are their constituent stakeholders. And then third, what do they do with that? And what do they do with that is not necessarily something that's overnight, but something that has to have just like everything else that's important, there needs to be a plan.
Very interesting.
Sorry, Louis, I know that this, I would just underscore that, you're not really opting into ESG as a company. It's really a part of kind of what you do. And I think the expectation from the investment community increasingly is understanding how companies are assessing these risks, how they're disclosing on these risks. And that's why I'm sure we'll get into a conversation about disclosure frameworks. But it's really important for investors to understand how these issues impact the financial operations of the company. And so I think that that's why you're seeing this kind of convergence around some of the frameworks like SASB and TCFD. It's just investors are really just trying to understand how companies are thinking about these risks, benchmarking, and so they can assess and assign some accountability to progress. Whether that's climate, whether it's human capital management issues, all of those kind of fall into that bucket of really trying to understand where a company is in its journey. So, you know, I think one of the important things is for companies to kind of get on this journey, because it is important, and it's the reality is not going away. If anything, I think COVID has just put a spotlight on the fact that, you know, health and economic well-being and, you know, some of these other kind of softer issues that are considered kind of everyday activities, which can be somewhat challenging to assess, are really critical in terms of how companies go about their decision making and how they disclose how they are, again, kind of managing these risks, not only at a high level, but also at an operational level, just really understanding how they're doing that.
Yeah, I find all these comments really, really interesting. I come from issues and crisis management background, right? So I used 25 years ago, I worked in the crisis management business. That's how I sort of got into ESG, because many of the crisis events that occurred, you know, with our clients had to do with an environmental issue or a social issue. They weren't termed ESG at the time, 25 years ago, but there were two sides to a crisis, so always two sides, right? Opportunity and risk in a crisis, right? And if the issues are managed well, if there are the correct policy, you know, material ESG issues, we would say today, right, are managed well, and there are great policies in place, there are metrics to measure the success of those policies or the, you know, non-success, and then disclosure on it in a standardized way that investors and others can use to make decisions that's comparable and within context and other, you know, important factors to make good disclosure, then ESG is a differentiator for a company, right, from their peers, to make them more competitive, to make them more resilient, to generate more value, to mitigate risk and create more opportunity. And we can go on and on about talent attraction, talent recruitment, and all the other things that come out if you manage these issues well. And that's really what I think, in my opinion, ESG is really a subset of issues which, you know, need to be managed well. So we talked, you know, a lot of the top. Go ahead, Catherine. Yeah, sorry.
I want to be real, because I do want to get to the other questions. I just want to add an editorial comment to that. When we talk about this as a crisis, I think we neglect the fact that this is probably going to change the way we live and work for the rest of our lives. And so, yes, we are in the midst of a crisis, but using that crisis as a way to build an understanding of how behavior is going to change going forward, how the status quo has been you know, changed. A friend of mine was on a panel and was asked, well, when are we going back to normal? And she said, you better embrace the change. And use the example of 9/11 and how before 9/11, we got to the airport, we took our water bottle, we got on the plane, and that was that. Now we go through security, we have to be pre-checked, we have to buy water in the airport and pay $17 for one bottle, whatever. That never went back to normal. And I think many of us on this panel believe that some of these changes need to be embraced. So.
Yep,
I was just going to say that I think that sometimes it takes a crisis to create real change. Sometimes we get change only after a crisis, and maybe this crisis in some ways will, you know, will surface, you know, some change that was what, you know, really needed for a long time, but it took that that kind of, you know, peak to get there. So sorry, Ray.
No. Listen, you know, I think all of us are very, very interested in this topic, and we have a lot to say, and we're very eager to share our views. I just want to chime in just on the point of resiliency. You know, part of the questions that we're in our engagement with companies now around COVID, we're asking them, what lessons are they learning? Because resilience isn't going back to what you were. Resilience is absorbing lessons and moving forward. At least that's how we think about resilience. So when we're asking questions about, so how is this changing how you're thinking about your workforce, how you think about the issues of diversity, how you think about your supply chain, you know, those are questions that we want to understand. What new elements are being incorporated into their thinking and their decision making that really can inform how the company is moving forward on a long-term sustainable basis. So, you know, and it's interesting because some of the companies that had a very rapid response initially some are flagging a little bit now in this middle innings because it doesn't look like, because because of the increased uncertainty in terms of whether or not these middle innings are going to go to extra innings in terms of, baseball leagues. And so we're all kind of dealing with some of the fatigue around that, but the tenor of the conversations has really changed from the initial response where, a lot of companies mobilized because it was a crisis, right? And they can mobilize around that. Well, now we're in this long middle innings, and we're starting to see companies really express fatigue among their employees in particular as to continuing to be productive in this very challenging environment with no real end in sight.
Yeah, and that leads well into my second question, which I think you may have answered already, but if anybody wants to add anything additionally to this, how has this COVID crisis and social injustice movements of 2020 kind of reshaped your approach, or your focus at your organizations? Are you looking more at capital programs now? Do you see more engagement and development of the workforce? Are there particular metrics that you're using too, for the companies in the audience? Are there particular metrics that you're using to assess companies in these areas that you might be focusing on now because of COVID and other social injustice?
I think the shift of the conversation to stakeholder, who are your stakeholders, rather than just who are your shareholders or investors, I think that's a paradigm shift. The fact that your employees, in some cases, may be the group that you need to listen to the most at a particular time, or who are you creating products and services for? I think that's a big shift, and that's why you're seeing the expectation on corporates to really elevate how they operate. It's a shift, and the fact that some of this data, whether it be your worker safety, we've had the least transparency into OSHA worker safety slips and falls and accidents than ever. It's gotten worse. And there's no reason why a corporate couldn't be transparent. We saw that with different corporates that just waited until the last minute or still are not fully sharing how workers have fared during this crisis. What is their rate brought out? How are you supporting workers? This is not a short-term issue. And Catherine, you brought this as well. This is going to be a topic and issue that needs to be addressed. There will be ebbs and flows on how this is. We might go into a lockdown for 2 months. How are workers going to, how are they going to survive? How are we going to treat them? So I think the issue sometimes is data, but the other point is, what's your plan? We always come back to what's your plan. You can throw data at us. Data is very important. We can talk about tying data to fixed income securities. It's a lot of fun. I had less gray hair when I started to do that, more gray hair as I've tried to do that. But Ray brought this out. We want to hear what your plan is. Just like if you had a risk mitigation strategy for anything you've been doing, we would expect you to have a capital plan. We would expect you to have a plan on growth. How are you going to grow your business? This is no different. And increasingly what we're seeing to the leading ESG-oriented entities is ESG is weaved into every element of a fundamental plan. I think to start, we've seen, this is my ESG plan. What we're seeing, I would say the entities that are really leading on ESG, it's how are environmental issues tied to my capital plan? How is my plan for achieving global growth tied to social issues like dealing with supply chain and human rights issues? I think that is the shift that will really move this into being the flavor of the month, to you being an entity that really is looking at achieving sustainable long-term growth and value for all of your stakeholders.
I think, first of all, I've been down to make a note on ESG has to be in every element of the ESG plan, and I want to quote that from you, Michael. I'm going to listen to our rebroadcast so I've got the words right, because I think it's so important. You had asked about the approach and the focus loops. I want to divide this actually. So the approach is in some ways to focus more on diversity, which is really a big theme, and We have seen, and I'm not the first person on these panels over the past several weeks, months to say the S has been greater in focus. A lot of our conversations in 2019 were about the E, a lot of environmental focused, and the S has come into play. We at RBC have always looked at all of the factors, but the engagement with clients, the interest level in clients on the S, and hearing what's going on the S and talking about what they're doing in the S has accelerated. In terms of the focus, we at RBC have an fixed income impact investing product that supports underserved populations. And we can target very granularly and geographically and to very clear census tracts or populations. And what has happened to us is it has become really important to corporations on the investment side to be able to align their investment with BIPOC populations. And where I would say 6 months ago, nobody talked about that. Now, every corporation wants to know how they can do that and act with their dollars and move and vote with their dollars. And that is a real direct transition for us in terms of prioritization among corporations with their balance sheets, and mobilizing those balance sheets has tremendous power, A, to drive change, B, to drive focus, and C, to align with ESG considerations. So,
So I would just highlight that, from a BlackRock perspective, we have 5 engagement priorities, and we typically they haven't changed dramatically over the years, but the emphasis may change a little bit. And those 5 priorities are board quality, environmental risk and opportunities, corporate strategy and capital allocation, compensation that promotes long-termism, and human capital management. So as you can see, we've had to focus on these kind of ESG issues. And depending on where our assessment reveals that a company may be lagging or may not be reporting, or we may not have enough information to do an assessment, that prompts an engagement for us. We've spent a lot of time on the governance, on board quality, because we do have this fundamental view that if you get the governance piece of it right, you have the right people in the seat, the board is fit for purpose, then they tend to make better decisions around the executive team in terms of having the right individuals in place to actually execute on the plan. So we actually, again, would reorder it. We would call it GES as opposed to ESG. But in the topic of diversity, for example, we've been talking about diversity for years. I think most asset managers have had, but the lens has been principally focused more on gender diversity. We broadened that out at the beginning of the year because the language that we use actually looked at other characteristics and elements of diversity, including race. And we started to communicate to companies that diversity wasn't just gender diversity, and with the recognition that there's still more room to go in terms of gender diversity as well. But obviously, with the pandemic, it's pulled the race conversation far more forward. But that's been a part of our conversations as well, just reminding companies that diversity is not just gender, and it's not just at the board level, but it's also at the corporate level as well. But I think if something that's important that's come out from COVID is that the focus on the metrics and the data to understand where companies are, and so we can push for improvements, quite frankly, is critically important. And in the S space in particular, that's really lagged. We've definitely seen some improvements in the climate area, particularly with the push on TCFD and SASB. But SASB also has components for human capital management as well, which are being developed. So I think the disclosure around it is very critical. So from a BlackRock perspective, there's not a reordering, so to speak, but we certainly are absolutely focused. We continue to be focused on the E, and we continue to be focused on the S, or the human capital portion as well. But there's definitely a bigger spotlight on it. Absolutely, no doubt about that.
What's interesting is, I think last week, an initiative started by the Illinois State Treasurer to get a group of large institutional investors, and they were surprised that for the launch they got 20 big, U.S. institutional investors who are really standing up and saying we need disclosure on diversity, and and beyond and beyond gender. And so, you know, if our investors care, we need to care.
Mm-hmm.
So.
The other point that I would make really quickly is that those 5 priorities I indicated to you or are highlighted, we're looking for alignment across those. For example, we don't take voting decisions on climate in a vacuum. We look at the other engagement priorities as well to really inform a very holistic view in terms of how we may think about, you know, exercising our vote. And increasingly, you know, we're looking to hold directors accountable in terms of, you know, oversight that they're meant to provide. And so, you know, this last year alone, we voted against over 5,000 directors for various issues. The other thing I'd say, just in terms of the boardroom and directors, is that it's been interesting in the pandemic that boards have been spending far more time, obviously, you know, kind of dealing with these issues and engaging with the management team. We've had a focus on boards being overboarded or board directors being overboarded for a number of years. And we've had several companies say to us, now we understand why you were focused on this, because it is important for board members and directors to have the capacity to actually be able to lean in and you know, provide the oversight and advise the company, particularly in moments like this. So I just wanted to draw a spotlight on that.
Great. I want to go to some questions from the audience. I'm looking at what's coming in. We've got a lot on Slido here, and you know, a couple of them are focused on metrics, and you know, how do you measure sustainability? That's a very broad question, I know, but this is coming up a lot on the Slido questions. So I think that ties into, you know, one of the questions that I had as well, which is, you know, how can companies improve their disclosure and transparency to give more material and decision useful information to you, especially in these categories that we're talking about now. So this goes into standards and other things, but I'll throw it open to you guys. I know you probably have a ton to say in this area.
Louis, I'll say one thing.
Sorry.
Go ahead.
I was just going to jump in because I have something very quick to frame this, and I know my panel mates will be able to build on it. I consistently hear from sustainability officers that we investors bombard them with all sorts of questions, and they have to answer each of them, and they are all different. So what I want to say about this disclosure and transparency is standardize it. Send us all the same list. You know what we want to know. Do it once and done. And that can be driven by the sustainability officers and every organization who are frustrated by the fact that we all want to know different things. So transparency and disclosure is important, but standardizing it is something that each corporation can drive by themselves. And I think we've been waiting for the industry to give us disclosures and standards, and certainly TCFD disclosures are gaining momentum, but you are empowered as a corporation to streamline this process with things that are relevant and material to your business. I hope that didn't disagree, Michael, with what you wanted to say.
You must have seen my notes that I had written down.
Sorry,
So,
I stole your.
what I'd say is I'm puzzled. Yeah, I'm equally puzzled by this. We don't know what data to share. There are clear constructs, and if you're not clear, I would say advocacy from the corporate side. Be an advocate for disclosure. You know who your industry peers are. You know, work on what the material issues are. Otherwise, yes, we're an investor and we will bombard you. That is our job on behalf of our clients to find out the information, in this case, data, plans, broader commitment to sustainability. If you don't tell us, we're coming after to ask you. And I think one of the developments here is that maybe this has been an equity construct in the past. Our fixed income analysts have engaged on a long time. Now you've given us another material factor where we know that there is data out there, because we know that 60% of your peers are reporting this data. We know that you may report this data to a governmental resource, but it's not necessarily public. So this I'd say previous era, we don't know what to report. If that's the case, let's work together to figure out what those issues are. I think we can come to them very quickly. The other point I'll bring is that, you know, as investors, I'd say, and maybe Ray and Catherine will agree with me. I think ESG focused investors are probably the most collaborative than any other area. We talk to each other all the time. We're there after the same issue, which is give us the information, and then let us make the decisions that are best for our clients. Let us have those constructs. So we're very happy to have corporates engage with us and also engage in these broad constructs so we can have some level of, I'd say, uniformity as much as possible across the industry.
I think, you know, just to make some sort of cliched comment, I have always believed a rising tide lifts all boats. And it's not a one-to-one relationship. As we elevate the dialogue, as we elevate the conversation, as we elevate the value proposition, we will all benefit societally and economically as individual firms for having accomplished that. And I see my peers as collaborators more than competitors for that reason.
Well, there certainly is value in having kind of a global standards, a standardization for the investment community. And that actually, I mean, I would say last year, I probably thought that was a bit more pie in the sky in the area of sustainability. But we've seen some tremendous movement just in the past 6 to 8 weeks. As you all probably know, that in January, we asked companies to publish reports that align with the recommendations of SASB and TCFD aligned reporting. Simply because we were being bombarded with requests from companies saying, help us make some sense of this alphabet soup of requests. One insurance company in particular that we engaged with earlier this year indicated to us that in 6 months, they had requests for 175 different third-party vendors for data and information. There was no way, and they were drowning in it. And so we've been asked consistently for the past at least 3 years to kind of help provide some clarity around that. And so we did endorse and support TCFD and SASB aligning. We are asking companies to provide that reporting by the end of this calendar year. And we think that that's important in terms of a step. What I would say is that we recognize that, you know, companies may be in different places in terms of their reporting journey. And we also understand that TCFD can be a significant lift and SASB can be a big lift for companies, having embarked on that journey ourselves. We released our SASB report earlier this year and our TCFD report also. So, and so I would encourage you to take a look at those. But I would say is that it's important to start this journey. And so it's important for you to, you know, release the data that's materially relevant to you. But it's also important to have the story, to understand the story behind the data as well. So the data alone is somewhat insufficient in that if you only release the data, then it leaves the investment community basically to fill in the gaps in terms of the narrative. And so it's important to have the alignment around both of those. And so, you know, I know that for some companies it can be a little bit daunting, but we are very encouraged by the movement that we're seeing since January around SASB, the adoption of it. They're more focused on incorporating international perspectives into their alignment, and the uptick that we're seeing in terms of TCFD as well. So a lot of movement in terms of establishing a global framework. And lots of significant announcements over the past 6 months that gives us some encouragement that we can actually get to one in a reasonable period of time. But in the meantime, we do continue to encourage companies to focus on TCFD and SASB.
Great. Yeah, I know I really appreciated the specific recommendations that came in that letter, the level of specificity, you know, that BlackRock gave in those CEO letters. So, you know, something that came up during our pre-call discussion I thought was interesting. I want to make sure we can touch on it. And this goes to Michael, you know, but it could go to, you know, if anybody else has comments as well. We were talking about sort of, you know, companies' commitments translating into, you know, the investments that they're making, you know, tying into fixed income and other types of vehicles and what they're doing in that area of the business, if it's aligning with their ESG, strategies, goals, material topics. And I wanted to ask you, how do you see this happening? Do you see that happening? Do you see challenges? Do you have any recommendations for companies, that want to, pull that area of their business into this and along? Michael.
Sure. So I would say this is probably one of the most encouraging areas of ESG, is that companies are swiftly moving into 3 levels. Help me understand, and I'm going to ask, maybe current clients or potential future clients on this call, one, challenge us. Challenge us as your fundamental investors that we're integrating ESG, and we can evidence that to you. And I would say, make it to a point where someone without ESG in their title can explain it to you. I mean, that's them. I say this joke my wife really dislikes. I want to work myself out of a position where every person on our floor, or now, 300 different floors since we're all in different locations, can speak to ESG in the way that's relevant. So that'll be level 1. Level 2 is we need to be able to report to you what are the ESG factors or disclosures within your portfolio, so you can make a choice. And the choice is, 1, to allow us to integrate ESG in a way that we believe is financially advantageous for you in the long term, or to allow you to make commitments that correlate with how you are operating your business. So for some insurance companies, they've made commitments to reduce their financing insurance of thermal coal. For different corporates, they've made commitments to funding certain communities, or actually funding areas of social justice. We had one client that actually took a sliver of their short duration portfolio and decided to go all in on green social sustainability bonds. And it was interesting, I'm gonna put a little, my nerd portfolio management hat on. They went so short duration that there were no green bonds. Green bonds typically finance longer duration projects, maturities of 30 years, 10 years at least. So they actually went down this interesting route of taxable munis. They found out that there's this massively growing market. Everyone knows about munis, but there's taxable munis, and they could finance the construction of a K-12 school. There was an issuance just today, and it financed mitigation or helping reduce homelessness and affordability for housing. So there's this discovery of this market, which we've known about forever, but discovery that this can have impact. So what I'd say is, whether it's a carbon tilt, whether it's a long duration portfolio, we know, because MSCIs of the world and Sustainalytics of the world have told us, is they're scoring you based on your investment policy now. So this is going to become a factor that your employees are judging you based on your investment policy now. And so the way you invest your assets, if you're a healthcare organization and your investments don't correlate with that, if you're an organization that says social justice is important to you, but your investments don't correlate in that is, I think, what's going to happen in 2021. That will be, I think, the evolution of ESG. How does ESG then correlate into how you actually invest your own assets?
So we also invest in taxable munis, and we've been doing it for 20 years. That have impact. They have to have impact. They have to be homelessness bonds or sewage treatment bonds or brownfield remediation bonds, all of these things. And I had a very interesting conversation with our capital markets people last week, where they said, oh my goodness, we issued a bond. The taxable muni market's been sort of not so great. We issued a green bond, and I guess thanks to Michael, they got huge interest in our capital markets group for that green taxable muni. And so I do think there's all these places where it's starting to move, and the value proposition is spreading. And I think that's really the key, is we need more and more people, and particularly inside corporations, to recognize the value proposition across customers, employees, shareholders. Michael used the term stakeholders, all stakeholders. And to highlight this from the top down, it needs to start with expertise on boards. And if the company recognizes the value, actions can happen. There's going to be more sustainable product. There's going to be more safety rules for employees. There's going to be more impact investing. There's going to be more focus when you issue your corporate debt on highlighting the sustainable things you're doing. It's all going to filter through, provided the value proposition is recognized from the top down. And I can't emphasize that enough on this call, but maybe other people can add to it or disagree.
Now, the only thing that I would add to that is that, from our investment stewardship lens, we look at it through this lens of, how companies are, managing their capital allocation in conjunction with their with our company strategy. So again, we look for alignment to make sure that if the company is saying this is what our direction of travel is, this is what our 5-year plan is, that they are making investments to really support that. But what I would also say is that, along the lines of what, Catherine and Michael are saying, is that, you are starting to see this reallocation of capital that Larry alluded to in his letter to CEOs at the beginning of the year, where he characterized climate risk as investment risk. And for the companies that really embrace that and articulate a strategy in terms of moving forward and embracing sustainability, that you would start to see this reallocation of capital in the marketplace. And I think there's some evidence of that. And if you also look at the returns to the first half of the year, as Lou started the conversation with, we've kind of come full circle. It definitely suggests that some of that is really starting to occur.
And I want to pose one more challenge. It doesn't matter what asset. You could have a treasury allocation. And we've seen not only us, we knew some of our peers are increasing trading with minority, women, and veteran-owned businesses as a counterparty, you could say, approach to diversity and inclusion. We're seeing distribution channels where your investment goes through one of these organizations. We're seeing entities make a commitment that I want my weighted average women on board, which is the best data we have right now. It is one of the best reported data, has to be better than the benchmark. Here's the important point. You have to make these commitments known. If you make these commitments and don't make them public, that's going to be a big issue. We had one investor who said, I'm not going to invest in any utility with more than 30% of revenue from thermal coal, only if they issue a green bond. I'll buy their debt if it's a green bond. And so these might be small steps, but making those steps public, they have impact on issuers. You're probably your peers, other corporates, on how they think about ESG. It's really a very strong loop that we're seeing as one of the most exciting parts about ESG going forward.
And just to underscore that, I think we would all agree on this panel that if you don't do it, if you do it, you are on a path to long-term sustainability and to long-term value creation.
All right, I think we're running out of time. I know we could go on and on. I would love to, and we've got great questions on Slido, and I'm sure this conversation can continue beyond this panel. So I hope so. But thank you to Ray, Michael, Catherine, for participating in this conversation. Thanks to the whole audience for listening, and thanks to Reuters for hosting us.
It's been a privilege to be with all of you.
Yep. Yeah, it's been a great panel. Thank you, everyone.
Thank you very much, everyone.
Thank you, guys. Been great listening in. And the team have told me we had over 50 questions submitted. So even though some were shown, there was a number that we couldn't show. But yeah, definitely a lot of food for thought for our audience. So thank you, guys, and take care.